So, imagine you're tracking a stock, right? And it suddenly drops almost 6% in a single session.
Yeah, a brutal 5.95% coup.
Exactly. It pulls back to $85.53. As an investor, you really have to ask yourself, are you staring at a glaring sell signal, or is this, a rare window to grab an undervalued asset right before it blasts off?
Right. And that is exactly the binary reality for anyone looking at AST SpaceMobile or ASTS as we sit here in late April 2026.
Which is the mission of our deep dive today. We're going to sift through all this fresh data. We have raw financial filings totally clashing with, well, severe technical orbit failures.
An evaluation spread from Wall Street analysts that is almost unbelievably wide. I mean, it's historic.
It really is. So we're diving into all of it. And hey, quick reminder for you listening, if you want to join this debate because this stock is highly controversial, drop your feedback in the comments. We want to hear from you. Also, be sure to like this video and subscribe to the YouTube channel so we can keep bringing you these deep dives.
And just briefly stepping in here, remember that this is a natural analytical debate.
Yeah.
We are synthesizing the data and the charts, but this is not financial advice.
Exactly. Do your own homework. But let's get into the catalyst for this roller coaster. That 5.95% drop puts ASTS in a definitive short-term downtrend.
Yeah, it does.
And a lot of retail traders might assume, oh, it's just macroeconomic drag. But our sources show this is a fundamentally operational shock, right? We are dealing with the technical orbit failures of the BlueBird 7 satellite.
Right, which is basically the single biggest fundamental risk for a space telecom architecture.
Because it shifts the whole psychology.
Exactly. The company's valuation relies entirely on deploying a continuous functional satellite constellation, to eliminate cellular dead zones. So the architecture has to be flawless.
And these aren't simple machines.
No, they are massive, incredibly complex, phased array satellites. If one fails to properly deploy or hold orbit, which is exactly what we're seeing with BlueBird 7, it's not just a loss of hardware.
Right, it creates a hole in the network.
Yes. It degrades the continuous coverage map. It introduces a gap in the mesh network. And that forces a huge psychology shift from aggressive optimism to a very cautious wait-and-see approach.
I mean, looking at the broader context, this stock is wild. It's trading at $85.53 right now, but the 52-week range is insane. It goes from a low of $20.26 all the way up to $129.89.
With a market cap of roughly $32.67 billion.
Which is huge, and the trading volume is averaging 14.25 million shares. But here's the crazy part. The beta is 2.8.
Yeah, that is intensely high.
I mean, a 2.80 beta is like riding a roller coaster without a seatbelt. Is this level of volatility purely driven by the news cycle, or is there an underlying structural instability here?
Well, to answer why the stock swings so violently, we can't just look at the news. We have to open up the company's ledger. We have to look at their actual cash burn.
Right, let's do that. Let's pull apart the deep dive financials for fiscal year 2025, because the top line numbers are kind of a mixed bag.
Very mixed.
Total revenue actually saw a massive late year jump to $70.92 million. And what's interesting is Q4 alone accounted for $54.31 million of that.
Which is a good signal. They are starting to generate real cash from early operations.
But they are deeply, deeply unprofitable. They reported a net income of negative $341.94 million.
Yeah, a diluted EPS of negative $1.34 for the year and negative dollars to 126 cents just in Q4.
So the earnings are a mess.
Well, institutional focus isn't really on net income right now. It's on the cash flow.
Oh.
And this is where it gets scary. Operating cash flow was negative $71.52 million.
Oh, wow.
But the free cash flow, the actual money draining out of the business, was negative $1.14 billion.
Oh, wait. Over $1 billion burned.
Over $1 billion. And $330.73 million of that FCF burn was in Q4 alone.
So, okay, let me push back on this. If a company is burning through $1 billion in free cash flow, how are they even keeping the lights on?
That is the big question.
Because looking at the balance sheet, it looks strong on paper. They have a staggering $5.01 billion in total assets against $2.62 billion in total liabilities. That leaves them with $2.39 billion in total equity.
Right. Their financial health in terms of capitalization is actually their strongest defense.
Yeah.
They have raised over $3.5 billion in capital to date.
So they are sitting on a mountain of cash.
Exactly. And they boast a robust current ratio of 16.35. They are fully funded for their initial constellation.
Meaning short-term liquidity isn't the threat right now.
Exactly. They aren't going bankrupt next month. The threat is how fast they burn through that war chest if they have to keep replacing failed satellites.
Right. Having a war chest is great for survival, but, it doesn't automatically stop a stock from bleeding out on the charts. Which brings us to the technicals.
And the technical indicators are definitely flashing warning signs.
Yeah, break down the trend direction for us, because the smart money seems to be moving fast.
Well, looking at the charts, ASTS is trading below both its 50-day moving average, which is at $89.30, and its 20-day moving average at $89.95.
So it's confirming short-term weakness.
Definitely.
Yeah.
And the 14-day RSI is at 55.3. Technically, that's neutral, but it's losing momentum. It's trending downward from recent highs.
So it's basically a battleground for traders right now. Key support is hovering at the recent daily low of $84.91.
Right. And if it breaks that, the secondary much deeper floor is all the way down at the 200-day moving average, which is $72.31.
That is a long way down. On the flip side, upside resistance is parked at $91.77 and $99.72. But the order flow is what really caught my eye. The short interest here is a massive red flag.
Oh, it's incredibly high. We're talking 19.52% of the float. That is 47.46 million shares sold short.
That is a massive bet against the company.
It is. But here's the kicker. There are only about 2.8 million shares left available to short.
Wow, so the borrow availability is basically tapped out.
Exactly. It creates this hyper-volatile environment. But the shorts are clearly emboldened by the BlueBird 7 failure.
And it's not just the short sellers circling the wagons. There is some intense insider selling happening right at this critical support level.
Yes, the Rakuten news.
Yeah! Hiroshi Mikitani of Rakuten, who is a major shareholder, just dumped 1.35 million shares at roughly $86.22.
Right at the battleground level.
Exactly. What does it signal when an insider sells over a million shares right there?
Well, it's a profound signal. This clash between major insider selling and the company's massive cash reserves is exactly what's causing a historic fracture in how the market values ASTS.
Because the analysts are completely split too, right? The consensus is holder reduced.
Yeah, let's look at the ratings. Barclays is underweight with a $65 target. UBS is neutral at $85. B. Riley is also neutral, but at $95.
And then Scotiabank is just brutal. They rate its sector underperform with a target of $45.60.
Right. And this completely divided opinion leads us to the ultimate debate. Is this a value play or a value trap?
Let's get into that valuation chasm, because it is staggering. On one side of the sources, we have discounted cash flow, or DCF models, suggesting an intrinsic value of $132.99.
Which would mean the stock is nearly 35.7% undervalued.
Exactly. But on the totally opposite side, you have these narrative valuations that peg the fair value at an abysmal 28 cents.
28 cents.
Yeah. They argue the current market cap is entirely stretched based on massive execution risks. I mean, pricing a stock at either $132 or 28 cents, that's like pricing a house at either $1 million or the cost of the front doorknob.
That's a great way to put it.
How can you, as an investor, confidently buy into a spread like that?
Well, that uncertainty is exactly why retail traders frequently get trapped in this specific type of stock.
Break that down for us. What makes it a trap?
It's the combination of high volatility, a history of dilutive funding, and these sudden satellite failures. It creates a cycle.
The cycle of buyers getting crushed.
Basically, yeah.
Yeah.
Retail buyers see a dip, say, down to $85 and think, oh, it's cheap. The DCF says it's worth $130, so they step in.
Right.
But then a satellite fails.
Yep.
The company has to burn more cash. They issue more shares to raise funds, which dilutes the stock. And then institutional short sellers just pile on.
So the retail trader gets crushed by systemic execution failures.
Exactly. So synthesizing all of this, the short-term outlook is undeniably bearish to neutral. The market is just digesting that BlueBird 7 deorbiting and the insider sales.
Which leads us to the worst-case continuation, the bear case.
Right.
In that scenario, the execution risk remains high. You get further satellite failures, heavy insider dumping continues, short interest stays elevated, and they just keep diluting shareholders to raise funds.
And grinds down to that $45 level.
Yeah. But let's flip it. What is the best case recovery? The long-term bull case.
Well, the bull case is actually quite strong if they can execute. Remember, they are fully funded for 2026.
Right, the war chest.
And they have major validated partnerships with titans like AT&T and Verizon. Plus, and this is the key, a massive $1.2 billion contracted backlog.
That backlog is huge.
It is. The key to the bull case is successfully launching the remaining 45 to 60 satellites by the end of 2026.
So they have to get the hardware in space and working.
Exactly. If they do that, they can scale commercial revenue to their $150 million to $200 million target, and all those shorts, they get squeezed out.
So 2026 is clearly the make or break year for AST SpaceMobile.
Absolutely. It leaves investors on a nice edge today.
It really does.
Yeah.
So to recap all of this for you, ASTS has a massive war chest. They have major telecom partnerships, but they are actively battling technical satellite failures, a broken chart trend, and heavy insider dumping.
Again, just to reiterate, our deep dive today is a natural analysis of the data, not financial advice for your portfolio.
Definitely. But I want to leave you with one final provocative thought to mull over. We talked about that $1.2 billion backlog. If AST SpaceMobile's execution risks catch up to them and they fail to launch this next wave of satellites, does that $1.2 billion contracted backlog just vanish into thin air?
Right. Yeah.
Or do giants like AT&T and Verizon just step in and buy up the core technology for pennies on the dollar? Let us know what you think in the comments.